the part of the show where we put a fund in the spotlight, and this week we're reviewing the Sanlam Global Financial Fund. So Cobie, please set the scene for us.
Yeah, I mean, again, we're looking at a global fund today. Again, previously we've looked at global funds, but never quite a financial fund. So this is Kokkie Kooyman's, the big fund internationally. It manages $237 million. That's its assets. Yeah. Formation date there is at April 2004. Just remember, there's a prior history here that kind of was set at Coronation Fund Managers before the fund moved over onto this, into Sanlam Investment Management. Objective is MSCI World Financial Index, obviously because it's a financial fund. And the TER there at 1.49%. Just to quickly look at some return numbers here for the fund. 12 months, 30.2 versus the MSCI World Financial Index at 20.7. 24 months, 33.5 versus 13.9. 3 years, 11.1 versus -6. 5 years, 6.9 versus -7.5. And then just since inception, here's a number here, 12.1% relative to the MSCI World Financial Index, which is at -1.5. Obviously, all those numbers are per annum, if they're longer than 12 months. Let's just look again at the chart that we look at on a weekly basis. This is the fund, and in this case, the Sanlam Global Financial Fund in dollar terms relative to its benchmark. That is the blue shaded areas. So the blue shaded areas, if it's above the line, such as over here, then that would be outperformance on a rolling 12-month basis. And if there's areas below, as you can potentially see over there, that would be underperformance relative to the index. And then on the rolling 12-month basis, on an absolute basis, this is obviously the return for the actual MSCI World Financial Index. And you can see this is a pretty decent and robust picture that you're seeing as an overall glimpse at the fund. Kokkie spoke just now about how few of the investors actually withdrew funds during the financial crisis, which is 2008. And there you can see the reason for that. You can see the returns are actually literally flat relative to the MSCI World Financial Index. So it certainly doesn't lose money to the same degree as what the MSCI World Financial Index does. Very probably you must look at those mid-cap and small-cap stocks that are within the fund, and they're financial, obviously, and the robustness of those businesses relative to some of the larger banks. And maybe we can get Kokkie to come and to comment about those issues just now. And then you see the massive outperformance for the fund on this side. And that obviously has been a continuous thing with the fund, because you've seen us since inception numbers that look absolutely fantastic relative to MSCI World Financial. Eleni, back to you.
Okay, so let's look at the benchmark. Are you happy with the benchmark, Roland? Do you think it's fair?
Yeah, in fact, I'd like to ask Kokkie about the allocation that he has to different what we call factors. For example, obviously the benchmark is market cap weighted, and it's quite a large cap bias. So where are the pockets of opportunities? Is there like a small cap bias? Is it emerging markets? Is it obviously there's a value bias? What kind of focus is there in the fund to try and outperform the index?
In essence, we never really look at the index, except that obviously we chose the MSCI index because that is what most investors, when they want to invest, want you to beat. But when we select shares, we don't do that being cognizant of, let's say, that the US is 45% of the index. In essence, all we really look at is try and unemotionally look at where are the best returns available, and if that is in small caps at that point in time, or that is in India, then that's where we go. And that tends to move around. In 2003-04, it was largely emerging markets and small cap, but actually any larger emerging market financials that did very well. 2009 was because the markets were so oversold. It was more the large caps banks that rebounded. And if you look now at 2012, most probably it's going to be the same. Your large cap banks are just being shot down so much. If you look at Barclays, Bank of America trading at 40-30% discount to their tangible NAV, and obviously in Europe now the same is happening. That I think once the crisis abates, that is where most of the opportunities are. And in a way, there has been, if you look at let's say the 11 years in total that I've run, the combined fund in the two, then there are some names that keep reappearing, and there are some shares that we've held almost consistently. But there is quite a bit of switching, and that's one advantage of being global, that we can go from small to large or developed markets to emerging markets.
Yeah. Okay, so Kokkie, I mean, looking at some of the risk but then again, we could get a high reward for it down the line. And of course, I'm alluding to what we're seeing coming through in Europe. Any thoughts about getting exposure to the likes of Greece or Italy, Portugal, the pink countries, so to speak? I know that ReCM has bought into Titan Cement, and it's a cement company in Greece. Would you be embarking on a similar strategy? I mean, is that a value proposition, or is it more like a value trap?
Yeah. Look, Titan Cement is obviously different as an example, because in fact in one of the other funds we are invested in a Greek jewelry retailer. So I mean, it all depends on the valuation, except if there's gearing. If they're financially geared, then there's higher risk of when something goes wrong in Greece. Obviously on the banking side and insurance side, there when a country collapses, then your risk escalates dramatically. So on the financial side, what we've learned is that it's best to wait for the crisis to be over. And to try and bottom pick while the crisis is still developing, it's very high risk. So sure, I think specifically Greece and Portugal, Ireland are the highest risks at the moment, because there's got to be a default and you don't know where the fault lines are and who's going to be hit the worst. But once it is over and you can go and do your homework, then there will be some really good and undervalued stocks to pick up. All your academic research shows as well, especially the behavioral finance guys, show that once a stock has been tarnished, it often takes 5 years for it to regain its rating. So you don't have to be there in month one. It often takes a long time for the markets to revalue the stock. So, what we are doing, I spent a week in Portugal, Spain a few weeks ago. So we're trying to stay in touch with the banks. We try and stay in touch with the managements, and so when the crisis has exploded, and you can go in and you have the knowledge.
Fantastic. Okay, we have to wrap things up. So, Cobie, just last words on specialist investment managers and the overall.
I always say it, and I think Kokkie has said it over and over and over today. Buy cheap, get return. Buy expensive, get no return.
Yes.
Simple as that.
But
Globally or locally. Doesn't matter.
And of course, there's a risk element though. Yes, Roland.
I think Kokkie's got three things in his favour. Firstly, he's got the autonomy to do what he wants. He's got some kind of ability to pick stocks from a valuation perspective, and I think there's something in the fresh air in Cape Town that also helps a lot.
Fantastic.
It's the red wine.
Is it the red wine? Okay, so maybe you should ship us some over here so that we can get some of what you're having. Thank you, gentlemen, for joining me. Much appreciated. That's all we have time for this episode, but we'll be back next Monday at the same time at 8:30 p.m. Central African time on CNBC Africa. Until then, from me, Eleni Jokos, and my insightful guests, it's goodbye.